right, welcome guys. I'm super excited for today's webinar. I'm glad you guys could all make it. My name is Sean O'Reilly. I'm the marketing manager here at Left Main REI. I'm just going to be mainly doing some background work, recording this webinar and ensuring your guys' questions are answered in the chat. But I'm super excited to announce our guest speaker is Jason Scott, who I'm sure you've heard of from the BiggerPockets podcast. He's just going to be talking about some economic topics in real estate, and then we're going to kind of move forward with a Q&A session. So without further ado, I'll hand it off to Jason and we can get the ball rolling.
Hey, thanks, Shauna. Hey, Stephanie. I think Stephanie's frozen. Hey, everybody. Thanks for being here. So I'm here today to talk about the economy, and I want this to be an interactive session. I'd love to do we can have a discussion. If anybody has questions, I'm happy to give my thoughts. In the past, I've done presentations on economic topics, but with things changing so rapidly these days, I find that having to give a presentation, I'd be updating the presentation every 3 days based on new economic news, and I just don't have the bandwidth to keep up with everything in a presentation format. So I'm happy. Let me start with just what I'm currently seeing, and I guess anybody that follows me on Facebook or LinkedIn has probably already read my thoughts here, but I'm happy to give my thoughts anyway. So let's start with just the general economic stuff before we jump into anything real estate specific. Generally speaking, economy-wise, nobody has any idea where we are. That's not true. Everybody has an idea where we are. Everybody knows exactly where we are, but nobody can agree. And so I know there was a lot of discussion a couple of weeks ago about, hey, we saw 2 quarters in a row of negative GDP, which for a lot of people, that means a recession. If you want to think that is a definition of recession, great. You can say we're in a recession. I think a lot of people like to be a little bit more nuanced than that. While GDP is a reasonable measure of economic stability and economic trends, it's far from the only data point that's worth looking at. And there are a couple of things that happened with GDP in the first 2 quarters of this year that I believe kind of disguises the true trajectory of the economy. I absolutely think that we're on the verge of a recession. I absolutely think that in a recession at some point in the very near future, but I don't think we're there yet, and I don't think looking at the GDP numbers is necessarily the right indicator of where we are, simply because there are things that happened back in Q4 of last year and that happened a year ago and that happened 5 years ago that have an influence on the GDP numbers that we saw in Q1 and Q2. So, but again, it's all semantics. Whether you think we're in a recession or you think we're not in a recession, that doesn't change anything. It's not like if the government declares we're in a recession, like something happens. We don't send out the National Guard. We don't doesn't trigger any policies to take effect. It's really just a word. So if you want to think it's a recession, great. If not, or if you're still open-minded about it, let's talk about some other things that we see that indicate kind of where the economy is at this particular moment. So we talked about GDP, and certainly the fact that we've seen 2 negative quarters of GDP in a row is an indication that things aren't trending well. You don't see negative GDP, even with the mitigating circumstances I mentioned. You don't see negative GDP multiple quarters in a row if there's not some issue with the economy. So certainly there is. As for whether it's bad now or it's going to get bad, if we look at a couple other things, number one, I like to look at unemployment. So unemployment is a really good indicator of where things are, because business performance tends to be a leading indicator of where the economy is headed. Typically, a lot of people like to look at what's going on with foreclosures, what's going on with savings rate, what's going on with bankruptcies, what's going on with things like that, personal data that reflects personal economic thriving or not. But in reality, if you look at business performance, that's going to be the best indicator of where things are headed, because it's always the companies that are driving the economy, and it's always the companies that are economy one direction or another. And the best indication of how companies are doing is one, looking at earnings, and two, looking at employment. And so let's start with employment. As of last week, as of last month, employment was still really strong. So we saw 3.5% unemployment, which matched historical low, a pre-COVID historical low. Now, it wasn't all good news. Of that 3.5%, there are some other numbers that can be looked at. Number one is something called the labor participation rate, and that's simply the number of people that are actually participating in the workforce. And that number is down about 1% over the last couple months. Now, percent might not seem like a huge number, but when you're talking about 300 million people, 1% is 3 million people. So that's a big number of people who, for one reason or other, decided they didn't want to be in the workforce right now. Now, what are those reasons? Some of them are good reasons. Some of them might be they were going to retire sometime shortly after COVID started and decided to retire early. Some of them, maybe they jumped into the gig economy and now they're driving for Uber, or they're doing something else instead of working full time. Maybe they invested a lot of money in the stock market or in real estate over the last 2 years and made enough money that they don't need to go back to work yet. So certainly that's the good side of the lowered labor participation rate. But then there's the potential.
I was just on the line with
So then there's maybe the not so good side, which is people have given up looking for jobs because they can't find jobs that will pay them what they believe they're worth, or what they were previously making, or what they need to make in order to survive. So there's good and bad with that labor participation rate, but generally speaking, when that number drops, it's a bad thing because it means fewer people are working. We are seeing that number go down. We're seeing a whole lot more families and providers who are taking second jobs and third jobs. We're seeing a whole lot more people that are taking part-time work and are cutting back on hours. So while we are seeing strong unemployment numbers, when you really dig in, the trend is not good. So that, to me, that tells me that we may not be in a recession yet. We're still relatively strong on employment, but the trend is down and the trajectory is heading in the wrong direction. On the other side of the business equation is earnings. And so how well are businesses doing? What we're seeing is that actually still relatively strong. So we saw retail earnings come out today, which is the first indicator that things might be starting to weaken. Typically, we like to see retail growth month over month. And last month, we saw growth of 1%, which was a little bit low, but was still a reasonable growth. For July, we saw 0% growth. So basically, that says that things haven't started dropping off a cliff yet, but we're not growing any longer. And the trend, again, the trajectory for retail sales is negative. So between those two things, between unemployment being still relatively strong, but heading in the wrong direction, and earnings being relatively strong, but headed in the wrong direction, that basically tells me that over the next 3 to 6 months, we're likely to see things get a lot worse. And so I think we are heading into a recession. But again, it's just a word. But if I were in charge of calling recessions, I don't think we're seeing enough on the business side to say that we're heading into a recession. Now, there are other things.
Jay.
Yeah.
Oh, I'm so sorry about my internet connection, but I'm just going to try it without my camera on. That seems to be working. So a lot of really great data points here. What's your favorite source to get these? Because there's so many talking heads out there. There's so many online resources. Where do you go to get these stats?
Well, it's funny. So just yesterday, I started posting on Twitter. Everybody kept asking me, where do you get your economic data? And I'm like, I get my economic data everywhere. I have a bunch of friends and we're kind of all in a WhatsApp group on our phones. And anytime one of us sees an interesting piece of data or an interesting article, we just post it to each other. And so I know it's not the people are looking for, because I'm not going to let everybody into my WhatsApp group. But I do highly recommend, like, start networking and talking to other people that track these sorts of things, that follow the economy, that are interested in the economy. Because I mean, just on social media, between Facebook and LinkedIn and Twitter and maybe Instagram, I come across articles all the time that I've never seen before. And so when I come across those, I share them with my friends. Well, I've never used Twitter. But as of yesterday, I said, okay, I'm going to start using Twitter just to start linking out all of these articles that I'm seeing. So feel free to follow me on Twitter if you want. But in general, what I like to do is at the beginning of the month, at the beginning of the week, or every morning, go on to Google and just do a search for economic news being released today. And pretty much every day there's going to be something that's being released. So it might be on Thursdays, we see unemployment data for the weekly unemployment numbers. At the middle of the month, we tend to see all the big economic data from the previous month that gets released. A lot of big companies have earnings releases throughout the month, especially here in July and August, right after the second quarter. So like today, if you did a search this morning for what interesting economic news or what new economic news is coming out today, you'll see that Target released earnings this morning, and Lowe's is releasing earnings reports today. And so those are things that all of these little pieces, you can start fitting them together when you start to see trends. There's a government bureau called the Bureau of Labor Statistics, so BLS. They put out a lot of really good information. So go check out the front page of BLS. Wall Street Journal. So just go online, read the Wall Street Journal every day, and they'll highlight the big things that are coming out. And then other than that, really, it's just I just do searches. And so, but yeah, they're big.
I noticed that you didn't say Fox or CNN there. That's interesting.
I do not. I do not. I'm not a big fan of the commentary about any of this stuff. Because even the nonpartisan, and certainly both of those are very partisan, even the nonpartisan media outlets are going to spin things based on, if not politics or their personal partisan views, they're going to spin things based on maybe their economic views, or they're going to spin things based on their personal financial situation. I mean, I could talk all day about like unemployment. I'm not unemployed, or I'm self-employed. And so my perspective is going to be different than if somebody out there that had 3 kids and couldn't find a job was talking about unemployment. Well, that 3.5 number, if you're in that 3.5%, then your view on unemployment is going to be different than if you're somebody like me who has a pretty stable self-employed income. So I try and stay away from the commentary. And I think of the economy and where we're headed, it's like a puzzle. And if I give you any one piece of a puzzle, you can't tell me what the puzzle looks like. If I give you any 50 pieces of a puzzle, you probably can't tell me what the puzzle looks like. But if it's a 1,000-piece puzzle, by the time you have 500 or 600 or 800 pieces, you start to get an idea of what the picture on the puzzle is. And it's the same way with economics. Any given data point, and it's the reason why I really hate like that 2 quarters of negative GDP being a recession, because I can give you 10 reasons why GDP can be a misleading statistic for where the economy is headed. But when you add in earnings, and when you add in unemployment, and when you add in consumer sentiment, and when you add in inflation, and when you add in a million other things, well, you start to get an idea of not only where we are, but where things are headed. And so I just encourage everybody, spend 10 minutes every morning and just do a search for economic calendar. And that'll basically bring up here all the data, pieces of data that are getting released today. And then just talk to other people that are interested in the same topic.
I think that's really great. I mean, that overall data diversity and from different sources, I think, is the key for sure.
Yep.
So we're all here looking at that kind of through the real estate lens and trying to properly predict what's going to happen in real estate and across different real estate, assets and classes too. Because I'm sure you have an opinion here, but I believe all those classes kind of behave a little bit differently depending on what's happening in those different data points, comparing single family to large multifamily to commercial like storage or office space or retail.
Yep.
What do you see across those different classes? Like what are your predictions there on what's going to happen across real estate classes here in the next 6 months?
Yeah. So let's see. This was part of a presentation I did. You can see down at the bottom from June. So I made
okay, great.
So I just opened this up because it was the last, literally, I just went into my presentations folder and it was the last economic presentation I did. So I don't even remember these predictions. So let's see how I did. I tend to be pretty bad. So inflation will continue dropping to above average levels by the end of the year, 4 to 5%. So we did see inflation drop for the first time in like 18 months, or inflation growth drop for the first time in about 18 months last month. We're at like 8.5% inflation average, as opposed to, I think we're at 9.1% the month before. I still think that it's reasonable that we could be at 4 or 5% by the end of the year. I was expecting things to drop off a little bit faster than they did, but I think we still have 5 months left or 4 months left. So I think 4 to 5%. I think we are going to see inflation continue to drop and pretty quickly. Fed will raise rates at least 3 more times this year, between 2.5 and 3%. We've already seen since then, we saw a June and a July rate increase. I'm fairly certain we're going to see either a 25 or 50 basis point increase again in September. So that'll be the 3. And I think we're going to be higher than 3%. We'll probably be closer to 3.5% after September, 3.2%, 3.25% by September. And then if we do another rate hike later in the year, which I think is iffy, it'll really depend. We could be closer to 3.5 or 3 3/4. So I still think we're going to have at least one more rate hike, and we'll have interest rates, federal funds rate at above 3, maybe even above 3.5%. That said, everybody assumes that when we raise interest rates, that means mortgage rates are going to go up. And that's what everybody, as real estate investors, that's what we're really more concerned about than the federal funds rate. We're concerned about mortgage rates. I did make the prediction back in June that we may see mortgage rates rise a little bit, but we weren't going to see them rise at the same rate as the federal funds rate. And I think I even on this presentation said I wouldn't be surprised if with 1 or 2 rate hikes we see mortgage rates go down, which is what we did see. Mortgage rates are actually in the closer to 5% range now. I think we got to a little over 6 at one point, but things are settling down. And if anybody wants to talk about that, we can talk about why mortgage rates don't necessarily move in lockstep with federal funds rate. But I don't think we're going to see mortgage rates go much higher than where they are now, even if we keep raising the federal funds rate a couple times. I thought it was unlikely we were going to see negative GDP in Q2. Turns out I was wrong about that. We were definitely negative in Q2. It was only 0.1%. So it was pretty close, but horseshoes and hand grenades, close doesn't count when you're talking about GDP. So I was surprised that we were negative in Q2. But I certainly still think that we're going to see, whether you think we're in one now or one is coming, I'm pretty confident that we're going to see a recession in the next year or so. At this point, I think it'll probably start in the next 3 months. I do think that inflation will be in check by next summer. I know a lot of people disagree with me on that, so we can come back next year and see who was right. But I really think we'll have inflation back down to pre-pandemic levels by the end of next summer or by next summer. I think we're going to see, I'll talk more about housing in the next couple slides, but in general, I think we're going to see housing drop considerably in some markets, specifically those markets that saw tremendous growth during 21, 22, when we saw population shifts throughout the country. There are a couple markets. I live in Sarasota, Florida, which saw crazy growth over the last 2 years. Boise, Idaho is a market that we've been watching that just absolutely nuts. the growth we saw there, and as well as a number of other markets that we've seen basically just outperform over the last couple of years. I think there's going to be some contraction in those markets. But in general, I think real estate is going to be it's going to be a relatively safe asset class to be over the next couple of years. I don't think that we're in for a big real estate downturn or real estate crash, even if other parts of the economy do see that. And we can talk about that, why that is in a few minutes. And I do think we're going to see interest rates and mortgage rates are going to drop considerably in the next 2 years. So whatever we happen to see in the next 6 months or 12 months or 18 months, I think within about 2 years, 2.5 years, we're going to get interest rates and mortgage rates back to where they were pre-pandemic, or not even pre-pandemic, but pre this year. And I think we're gonna be right back where we were, if not like crazy high growth, because we won't see the same inflation. But I think we'll be on a growth path again, probably within 2 years. Let's see. I invest in multifamily, and I think this particular presentation was geared towards multifamily investors. So I talked about multifamily. But let's talk about how single family and multifamily kind of are different. Number one, single family values are based on comps. Multifamily and other commercial values are based on income. So if I own a single family house, and regardless of whether I'm renting it for more next month than I rented it for this month or last month, if the house next to me that's similar goes down in value, because the person sold it, my house is going to go down in value. Again, it doesn't matter if I'm renting it for more now than I was. If the house next to me goes down in value, my house goes down in value, because that's how comps work. On the commercial side, things are a little bit different. On the commercial side, the value of a property is directly related to its income. So if incomes go up, then the values are likely to go up. It's directly related to income and this thing called cap rates, which is a multiplier. If income goes up and we don't see a big shift in cap rates, then most likely the value of the property is going to go up. And so I have a feeling that we're going to see kind of a divergence when we talk about real estate and how it's doing over the next year or two. We're going to kind of have a divergence. Those who are in the single family world are probably going to be thinking things are worse than those who are in the commercial world, simply because I believe that single family is going to take a hit, especially in some markets. But I think on the commercial side of things, we're still going to see strong rent growth. We're still going to see strong income growth. And so I think we're going to see continued growth in value over the next couple of years in the commercial space. Now, it's not necessarily going to be like it has been the last couple of years, because we do have the second thing that impacts commercial values, and that's called cap rates. And basically, again, it's just a multiplier in each market. It's basically what investors are saying that they require in terms of return for the particular market and the particular type of property. And so as cap rates go up, values go down, and it's likely that we're going to see cap rates go up a little bit over the next 6 months, maybe even the next 12 months. But I still think that that income increases, thanks to inflation and rent increases, are going to overshadow that. And I think we're going to see the commercial values are going to stay relatively strong. In terms of rents, rents are actually an interesting thing. And I don't think I have the slide in this presentation. But the interesting thing with rents is that we have never in the history of this country, on a national level, certainly we see it on local levels because all real estate is local, but on a national level over the last 100 years, we've never seen rents drop. Rents basically only go in one direction. 2008, on a national level, we saw rents flatten out for about 12 months, maybe 18 months, but didn't drop. Rents don't tend to drop. Now, in this case, I still think on a national level, we're not going to see rents dropping. But we will certainly see that on a local level in some markets. Again, there are certain markets that are likely to get hit harder than others. But in general, I think rents will continue to be strong. We're not going to see the same type of growth that we have seen as inflation slows down. But in general, buy and hold real estate is going to be a good place to be, because rents are going to continue to be strong. let's see. I mentioned cap rate expansion, and I think cap rates will drop again in the next 24 months. In other words, I think that multiplier that defines kind of how much real estate's worth relative to the income it's generating. I think that multiplier is going to go up. Cap rates dropping means the multiplier goes up. I think we're going to see that multiplier go up again over the next 24 months. And I think we're going to basically be back where we were 6 months ago within the next 2 years. And I think we're going to continue to see price increases in the multifamily space and in the commercial space for the next 5 years. Now, here's the interesting thing about real estate. It's good that real estate isn't necessarily correlated to the broader economy as much as things like the stock market. So if the economy kind of goes into the toilet, the stock market's going to go into the toilet, crypto is going to go into the toilet, a lot of other asset classes are going to go into the toilet. Real estate tends to not be tremendously correlated to all those things. So while everything else could be underperforming and doing poorly, real estate can do pretty well. And in fact, if you ignore 2008, let's pretend 2008 didn't happen. If you look at pretty much every other recession back to the Great Depression, real estate performed decently. In some cases, it didn't go up, but in most cases, it didn't go down or didn't go down much. And that's simply because, again, real estate is not necessarily correlated to other asset classes in the broader market. A lot of times people will move money out of the stock market and move money out of collectibles and move money out of bonds or whatever it might be and move it into real estate because real estate tends to be a good long-term hedge against inflation and also tends to be a good long-term hedge against volatility. So generally speaking, again, if you ignore 2008, real estate doesn't track other asset classes during a recession. Now, that's the good side. The bad side is that real estate tends to have its own cycles. And a lot of times we'll see real estate underperform during times when the economy is actually relatively strong. So over the last, again, 100, well, in this case, 150 years or so, we have this thing called the real estate cycle, which basically says that every 18 years or so, we tend to have a real estate downturn. Now, it's funny because I'm not a big fan of like these rules of thumb every X number of years, but this has actually been pretty consistent for reasons that nobody can really explain, with the exception of right after the Great Depression and right after World War II. This 18-year cycle for real estate has actually been pretty consistent. So if you're a believer in that real estate cycle and the 18 years of that real estate cycle, we're probably headed for a downturn somewhere around 2026. Now, again, can't explain why that 18-year cycle is 18 years. So I'm not going to sit here and predict a downturn in 2026, but it is an interesting data point. So in general, I think real estate is going to stay strong throughout this downturn, and I think we've got at least a few more years before we have any major concerns with housing in general and even commercial real estate. Let's see, again, this is more multifamily focused. Yes, great time to be acquiring because things are softening and values aren't dropping, but they're not going up for the first time in a while. I do think that that if you're buying anything that has at least a 3 to 5 year time horizon, whether it's commercial or residential, you're probably poised to do pretty well. Because again, I think in 2 years, we're going to see mortgage rates and interest rates start to drop again. In the next 3 to 5 years, I think we're going to see continued growth. So I think anything, and again, don't quote me on this because I've been wrong before, but I'd be comfortable with anything I buy today is going to be worth more than more than what I bought it for in 3 to 5 years. Let's see. In terms of where I'm buying and where I recommend other people buying, the biggest things that influence buy and hold real estate are, number one, population growth, because that's your customer base. The more customers you potentially have, the more demand you potentially have, the higher prices go, the higher your rents go. Number two is employment growth. So again, people move. Population growth is led by employment growth. As companies move into certain areas, people move into those areas to take those jobs. So again, employment growth is huge. And then number three for me, and in some cases, this is the biggest one, I like to see economic diversity. So if you look back at 2008 and 2001 and the early 90s, like the last three recessions, if you ignore 2020, basically the areas that got hit the hardest were those that had the least employment diversity, those areas that were reliant on one company or one industry. Good example, I'm in Florida. Florida got hit really hard back in 2008 and 2001. But the areas in Florida that got hit especially hard were places like Orlando and Miami, because they are so heavily reliant on tourism. And tourism got hit really hard during 2008 and 2001. And so when you have an area that's reliant on any one industry or any one company or small set of companies, those areas are at high risk if something happens again to that industry or to one of those companies. So I am a big fan of follow the population growth, follow the employment growth, and follow employment diversity. And what we're seeing now these days is that a lot of that growth is to the south and to the east. So Texas, Florida, North Carolina, South Carolina, the Sun Belt states. Why is that? Well, the big reason is one, lower income taxes, and two, sunshine. There are a lot of people these days. Back before COVID, about 15% of the workforce had the ability to work remotely. Now it's over 25%. And when people have the option to work anywhere they want, they're going to work in places that are cheaper to live and nicer to live. And it just so happens those places tend to be in the South and the Southeast. So if you were to ask me what markets I would focus on, well, the markets I'm focusing on, again, are Texas, North Carolina, South Carolina, Georgia, though I think Georgia has some potential risk just with various things. I'm not buying in Georgia right now, but I like Georgia in general. And same with Florida. Florida is one of those places where it checks a lot of the boxes, but there are other reasons why I'm not buying in Florida right now. But South and Southeast are kind of where I would be. So follow those migration patterns, and that's where the best places to invest over the next 5 or 10 years are likely to be. Let's see. So Zach asked, what's your best recommendation in measuring economic diversity? It's a good question. I don't really rely on any specific piece of data or pieces of data. This is more just looking at an area in general and seeing, I mean, if you go to, let's say, for example, I invest in Texas. And if I were to go to I invest a lot in Houston specifically. If I were going to go to the Houston Chamber of Commerce website, and I've done this, I can find basically this pie graph that says X% of GDP for the Houston metro area. Hey, sorry, new puppy. X% of GDP or X% of employment within the Houston metro area is in healthcare. Y% is in energy. Z% is in retail, whatever. And you can basically see, is 60% of your economy tourism, or is it basically broken down nice and evenly across 5 or 6 or 8 or 10 different industries? So I guess if you were to ask what the best source of data is, go to the Chamber of Commerce for the various areas that you're looking at and just look for a breakdown of either GDP or employment numbers by industry, and see, is it spread out nicely across a lot of different industries, a lot of different companies, or does it tend to be focused on 1 or 2 big industries, in which case that's where your risk is. So Stephanie asks, what are you selling? What changes have you made in your portfolio? Yes, so I'm trying to think the best way to think about this. In general, whenever I see potential softening in the market, I'm not necessarily worried about real estate values, because a lot of the real estate I'm holding long term. But what I am worried about is all the things that that are coincident with real estate and values and all the other things that are going on in the economy. The biggest that I tend to see is when we have recessions, when we have downturns, is we tend to see credit tightening. We tend to see lending really tightening up. And so the biggest, and anybody that was investing in 2008, I don't need to tell you this, you probably remember this all too well. But for anybody that didn't invest in 2008, it's always interesting when I try to explain to them that, yeah, property values were half off. Like literally we were buying houses that were 40, 50, 60% lower in value than they were a year earlier. But the problem is we couldn't get loans. Nobody was lending to real estate investors or homeowners or anybody. We were flipping houses. And so literally we would go to sell a house and we'd have to get under contract 3 times because 2 out of 3 buyers couldn't get their loans. And so typically during a downturn, tightening credit is one of the biggest risks to investors and to the people we're selling to. So one of the big things I look at in my portfolio when I look at us heading into a downturn is what properties am I not comfortable holding for at least 5 years? And what properties am I going to have to refinance either because I'm going to need the cash or because the loan is coming due or for whatever other reason in the next 5 years? And if I have any properties that I'm not comfortable holding for 5 years, or if I have any properties, well, if I have any properties I'm not comfortable holding for 5 years, I sell them. And if I have any properties that I believe I'm going to have to refinance or finance in the next 3 to 5 years, I'll typically do it now. And so I have a few properties that I want to hold. I don't want to sell them, but I just finished doing rehabs on them. I just got tenants in there, and I know that I have short-term loans that are coming due. And so basically I have the choice between do I keep these loans that I have coming due that are due probably in the next 18 months at low interest rates, or do I refi now that interest rates are in the 6-7% range longer term, but lock in loan terms? And so I know a lot of people who, well, they say, well, if you have 18 months left on the loan at a low rate, wait a year, then you'll still have 6 months left to refinance, and hopefully rates are lower at that point. Even if they're not, you've gotten low rates for the next year. Well, my attitude is in a year, I don't know if I'm going to be able to get loans as easily as I can now. I don't know what lending is going to look like a year from now. So I'd rather lock in longer term debt right now. When I say longer term, again, either 3, 4, 5, 6 years at higher interest rates. So that way I don't have to lose sleep over the fact that maybe a year from now when that loan is coming due, I may not be able to refinance. So the 2 big things I'm doing, I'm selling anything I don't want to hold for 3 to 5 years. And I'm refinancing anything that I'm going to have to refinance anyway or finance anyway in the next 3 to 5 years. So those are 2 big things. I actually sold off about a third of my single family portfolio over the last 6 months for that reason, holding everything else. Again, I'm pretty bullish on commercial. So we're not selling any of our multifamily stuff, at least nothing that we weren't planning to sell anyway. And so if I had any other commercial real estate, I wouldn't be selling that now simply because I was concerned about the market. So again, not overly concerned about real estate moving forward, but I don't want to be holding anything that I'd be selling in the next couple of years anyway. I'd rather just sell it now. A couple other things I'll say. Now is a great time to be working on your credit. So again, if lending tightens up, right now, I think, or over the last decade, basically you can qualify for a conventional mortgage with, I think, a 640 credit score. Back in 2008, that went up to like 720 or 740. Like literally, unless you had at least a 720 or 740 credit score, you couldn't get a conventional mortgage. So that gives you some idea of why credit score is so important these days. I like to tell people now's a great time to be taking out more credit. And when I say take out more credit, I don't mean take out more money, but increase your credit line. So if I have a credit card that might have a $20,000 limit, now's a good time for me to call the credit card company and say, hey, will you increase my credit limit to $30,000? I may not have any plan to actually use that extra $10,000. I'm certainly not going to take it out now, but having access to it now may be very beneficial later, because in a year from now, if credit starts to tighten, the credit card companies aren't going to want to raise my limit. And they may even lower my limit. So I'd rather them lower it from 30 back to 20 over the next year than lower it from 20 to 10. Likewise, if you have equity in a personal residence right now, great time to be getting a HELOC. So again, don't necessarily take money out on the HELOC, don't borrow from the HELOC. But if you can get that credit line available to you, who knows, maybe in a year or two, credit's really tight, you come across a great deal, and now you have a couple $100,000 in a HELOC that you can use to lock up that deal until you can refinance. So now's a great time to be basically extending or increasing your credit as much as possible. Those are the big things. Let's see. Other questions? Feel free to unmute if you want to ask.
Jay, I was wondering if you have looked at any alternate financing when rates started to trend up, and also if you're looking, next year when credit starts to tighten up, are you looking at anything like debt funds or doing like tenant and common 1031 exchanges, anything like that?
Yep. Stephanie, real quick, so I don't have to take a poll. What percentage of the folks on the call would you say are in anything other than single family? Who here is doing multifamily? If you are, just put in the
Sorry,
chat.
it wouldn't
okay.
let me unmute. It wouldn't let me unmute. I think primarily everyone from just scanning through is single family that
Okay.
dabbles in multi.
Okay. Yeah, I don't want to go too far into the weeds if nobody's going to be interested. So some answers to your question, Tommy. Certainly on the commercial side, we're seeing some changes. So again, with commercial, it's all based on income. Doesn't matter how good your credit is, doesn't matter how big your bank account is or how much income you're making. Basically, all the loans are strictly based off of what's called debt coverage service ratio, debt service coverage ratio, which means banks will loan based on a percentage of how much, what percentage of income that you're getting, because they want to know that you can pay back the loan plus have extra money left over to pay all your expenses. And so what we're seeing now is with more traditional type financing like Fannie Mae, Freddie Mac type loans, what we're seeing is that you can't really support those loans at high loan to value ratios anymore in the commercial space. So what I mean by that is if I were to buy a big multifamily property tomorrow and I went to Fannie Mae and I said, I want you to finance this, and I showed them all the numbers, because interest rates are so high, they would probably come back and say, I can give you a 55% loan to value ratio, or a 55% loan to cost ratio, or 50%, or maybe 58%. As opposed to a year ago when we could typically get the traditional 75% loan to value or loan to cost. And so for a lot of investors now, we can't get loans that allow us to buy these properties unless we're raising a whole bunch more money from investors. And when you raise money from investors, that money is more expensive than a lender. So in general, because the lenders are willing to lend less, and because we have to make that difference up with equity investors, our individual investors or institutions coming in investing in the deal, we can only afford to pay a lot less because we have to pay so much more to our lender and to our investors. So it's certainly impacting values, and it's certainly impacting the ability to buy in the commercial space these days. I think that's going to be short-lived. I think we're going to see things loosen up again over the next few months. But I think over the next 3, maybe 6 months, we're going to see a lot fewer buyers in the commercial space. So if you're in the multifamily space, if you're doing stuff that's over 5 units or over $1 million in loan, there's going to be some opportunity, because there's going to be a lot of buyers who just can't get the types of loans they need to make the deals work. So you're going to have to be able to negotiate well. You're going to have to find those sellers that are getting a little bit more desperate. But I think we're going to see more opportunity than we've seen in a while. In terms of creative financing on the single family space, or the single family side of things, I mean, the best types of lenders for single families for investors historically have been portfolio lenders. And these are these small local banks that lend basically their own money to investors. And because they're lending their own money and not the government's money, they get to make their own rules. And so they can choose to lend to you just because you've had an account with them for 20 years and they know you and they trust you. Again, they make their own rules. And so portfolio lenders have been a huge source of capital for investors over the past decade. But typically what we see during downturns is portfolio investors tend to get very shy. They tend to get very conservative in their lending guidelines and their lending standards. And so typically what we see is that it's much harder to get investor specific loans during a downturn. So what I typically recommend to anybody that's in the space, go start building those relationships now. Go to the 5 local banks that lend to investors, or however many you have in your area. I have 5. I'm in Sarasota, Florida, which is a 500,000 person city. And we have 5 banks that are these portfolio lender type banks. So you're probably, wherever you are, you're probably in the 2 to 8 range. Go find all of those banks, and to find them, you basically pick any bank that has more than 2 branches, fewer than 10 branches, and you pick up the phone and say, do you do portfolio loans for investors? And find the 2 or 3 or 5 or 8 of those in your area and open up a savings account or a checking account with those banks. Just throw $1,000 in, and then take the VP of commercial lending out to lunch and just say, hey, I'm an investor. I work in this area. I just want to start building a relationship. I've opened an account at your bank. If I ever have any deals, can I come to you? And most of them will say, yeah, come to us. And as you build that relationship and as they get to know you, and as you use the services for some of these banks, you're going to find that they're going to offer you better terms than you're going to get through traditional lenders. They're going to offer you better terms than you're going to get through other local banks. Again, during a downturn, it may be harder for them to lend. But if you start building that relationship now, maybe they will lend. And even if they don't, by the time the recession's over and you're ramping up your business again, all the people that are like introducing themselves for the first time to these VPs of commercial lending are going to be at a disadvantage to you, who now has a 2 or 3 year relationship with them. So definitely from I don't want to call that creative financing, but from an investor financing perspective, start building those relationships with your local portfolio lenders. What else?
I'm just going to say that seems to be like always kind of classic advice too. You know, portfolio local lenders always seem to be the strongest.
Absolutely. And from a more creative standpoint, find other investors who have a lot of cash. I can't speak for all investors, but I'm one of those investors. I have a ton of cash, but I hate looking for single family deals because I'm focused on multifamily almost full time now. I do very little single family on an active basis, but I have cash. And so you come to me and you prove to me that you know how to flip houses or you know how to buy rentals, and you say, hey, let's partner on some deals. Well, I may be very happy to partner with you on a deal. You don't need to go to a lender at all. So there are plenty of investors out there who have cash but don't have the time to be looking for good deals. Go find them and introduce yourself and take them to lunch and build a relationship. Because in a year when it's hard to get loans, potentially, I'm not saying it necessarily will be, but if in a year it's hard to get loans, the people that have the partners who have cash or the people that have cash themselves are going to be at a huge advantage. So start building, again, those relationships now. Like Stephanie said, this business, it's always about relationships, but especially now.
I'm just going to give everybody a chance to pipe up and ask any additional questions. I don't want to dominate either with my questions. Anybody else want to
Dan
ask
asked if
anything?
I'd be interested in Omaha, Nebraska. So I personally wouldn't be interested in Omaha, Nebraska. Basically, for single family, I invest in 4 states now: Maryland, North Carolina, Georgia, and Florida. And they're all places where I either have partners or I have people on the ground that I've worked with for a long time. But that's exactly how you do it. just go find somebody, if you're in Omaha, go to your local real estate investor association and just find the cash buyers. And I guarantee you'll find some that have plenty of cash and no interest in actually looking for deals. So they're looking for partners.
Do you mind expanding upon your feelings on Georgia and Florida on why you're not looking at deals there right now?
Yeah, let's start with Florida because that's the easiest. Number one, I hate investing where I live because then I end up working too hard. I find it really hard to outsource if I'm too close to my properties. But that's not the main reason. The main reason for Florida is I'm concerned about the catastrophic insurance risk. So Florida is going through a lot of crazy insurance things these days. A lot of traditional carriers don't work in Florida. And so we tend to have a lot of smaller and mid-sized carriers in Florida that are at high risk of going bankrupt if there's some major event like a big hurricane or a big storm that hits somewhere on the coasts. So for that reason, I'm a little concerned that if there are any really big storms over the next couple of years, we could find that certain properties are completely uninsurable. And when a property is uninsurable, basically the value of that property to an investor essentially goes to zero. And so I like to talk about the fact that the nice thing about commercial real estate and real estate in general is that the value of your property basically never goes to zero. I mean, unless you're building ground up and you're buying land, it's near impossible for the value of your property to be zero, because if it can make $1, it's probably worth at least $15. But if you have a multifamily or a commercial property that is completely uninsurable, in essence, your property has now gone to zero value. So that's my biggest reason in Florida, just because there's a whole lot of things up in the air on the insurance side. I'm not saying that Florida is necessarily a bad place to invest. I know several large investors, including a very, very large multifamily syndicator. He bought 6,000 units in Orlando last year, or around Orlando last year. Personally, I think that's bad for other reasons, because of, again, the employment diversity. Orlando is not the most diverse place for employment, but I don't believe that there's a ton of insurance risk there, simply because there's probably not going to be any major storms hitting the center of the state. Orlando is kind of in the center of Florida. But I definitely stay away from the coasts of Florida. And then the more center of the state tends to be heavily tourism, so I stay away from there for that reason. As for Georgia, I don't know if I think for Georgia, for me, it's less about the data and just more about I've had some experiences. I basically was in Georgia back in 2008, and for reasons I couldn't really enumerate, the Georgia market got hit a lot harder than I would have expected back in 2008. And I still don't understand why that is. We saw decent population growth. We saw decent economic growth. We saw a lot of employment diversity. And I've looked at the data for a whole lot of markets from 2008. And I can pretty well correlate the factors that led to a big crash in many markets in 2008 with those population and employment pieces of data. Georgia, especially Atlanta, was just one city, and it's crazier because I live there. So you would have thought you'd think that I'd have more information, but it's just one city that I never really understood why it tended to fare so poorly during 2008. And I've kind of always said that until I understand better why Georgia or why Atlanta got hit so hard during 2008, until I understand that better, I'm going to be careful about investing there. I still don't understand that. So I'm not saying Georgia is a bad place to invest. I'm not saying Atlanta is a bad place to invest. I actually own 100 single family houses in southern Georgia, in a town in southern Georgia. I'm specifically talking about Atlanta here. Yeah, there's really, I can't put my finger on why I don't like Atlanta or why I'm concerned about Atlanta, but I saw some weird stuff in 2008 that I still can't reconcile. So it's just kind of scared me a little bit.
I definitely think that you've got to pick markets that you understand, right? And investments that you understand. So That's good. I mean, if you don't know, then I think that's enough of a red flag for anybody.
Yeah, it's crazy because I would say I know the Atlanta market maybe better than any market I know in the world, but I just don't understand what happened in 2008, and not understanding just makes me want to hold off. Petra asks, I invest in Florida and Michigan. I struggle with insurance in Florida. Is there a company you can recommend to do a blanket portfolio? I would find a good broker. So Florida is just so weird. There have been a number of companies now that are saying they won't insure houses that have roofs that are over 15 years old. There are companies that are no longer insuring in floodplains. There are companies that are just like that are not going out of business, but have just stopped insuring. I don't quite know what's going on. I've heard a few people speculate. I've talked to a few people in the industry, but yeah, I'm insurance isn't my area of expertise, and Florida is just a weird place. So I would find a really good insurance broker in your area and talk to them. Sorry, I can't be more help there. Let's see. Ray asked, are you bullish on all commercial asset classes or multifamily only? I think there'd be some options. Yeah, so that's a really good question. I talk about commercial kind of as a big lump together thing, and I would tell somebody else not to do that, so I should be careful about doing that. When we talk about commercial, like Ray pointed out, there's a lot of parts of commercial. So there's multifamily, obviously, that I'm in, but there's also office space and warehouse and mobile home parks and RV parks, and industrial and retail, and I could probably think of 20 more, self-storage and so many others. And so each of these is their own asset class in essence. I mean, they're all commercial real estate, but they all kind of play by their own rules. They're all impacted by different parts of the economy. They're all going to see, they're all correlated and negatively correlated to some degree. So never mix all of those together. So to be a little bit more specific, right now I am bullish on multifamily. I think residential in general, I'm bullish on. I'm bullish on warehouse. I think we're going to see a lot more online buying and decentralized distribution centers. So I think not only companies like Amazon, but I think a lot of companies, instead of selling through Amazon and allowing Amazon to do their fulfillment, a lot of bigger companies are going to start doing their own fulfillment, and they're going to start buying a lot of warehouses around the country. So I think warehouse is going to continue to do well. Light industrial, that can be zoned for lots of different things. I mean, everything from parking lots to gas stations to office space. I think light industrial is likely to continue to do well. I think office is probably poised not to do tremendously well. Office was overbuilt over the last 10 years. And if you're buying in a place where there's still a lot of businesses moving in, it might do well. But I think in general, office has been pretty flat for the last 2 years for obvious reasons. And I think it's actually likely to get worse. Retail is kind of the wild card. I think you have to have your PhD in that by itself to know anything about retail. So I'm not smart enough to know anything about retail, so I don't want to say anything there. Self-storage, I think self-storage will continue to do well. I personally thought self-storage was maxed out back in 2009. And I wish I was smarter back then, because I would have been buying self-storage for the last decade. But I think self-storage still has a decent amount of growth, especially in areas that are seeing more growth. So those secondary and tertiary markets. That's the other thing with commercial. I can say things like, I like self-storage, but location is super important. I don't like self-storage in primary markets. I wouldn't buy self-storage in Phoenix or Charlotte. But I'd be happy to buy self-storage in a secondary or tertiary market. So anytime you're looking at these asset classes, look at it from a lot of different angles. So make sure you look at the market size and the location and what other things it's correlated with. So certain things are correlated with population growth, other things are correlated well with population decline. So yeah, it's hard to talk about commercial as a homogeneous entity. But in general, I'm pretty bullish on a lot of different commercial areas outside of office. I'll leave it at that.
That's awesome. I know we're coming up on time, so I'm just going to give everyone just a couple more moments to put their questions in, just so we can respect your time. Talking about metrics, economic or and national. I'm kind of surprised that you didn't mention things like MLS data, especially for the residential, single family residential stuff, like days on market and, you know, percent above listing price or percentage of listing price. Do you feel that's because those aren't as accurate as those other economic markers, or do you feel that those are just lagging metrics?
So honestly, the biggest reason is simply because I'm not focused on single family much anymore. And for me, I think of single family, again, going back to the very beginning of the discussion, unlike commercial, single family is very much driven by what your neighbor sold his or her house for. It's driven by public sentiment. Much less than it is driven by fundamentals like income and cap rates. So I could speculate based on what we're seeing on the MLS, and I'm happy to speculate based on what we're seeing on the MLS and all those things. But I also recognize that what we're seeing isn't necessarily reflective of pure economic forces or trends. A lot of it is driven by consumer sentiment. And so if consumer sentiment were to change tomorrow, and in some ways it has, I mean, I think 3 months ago, a lot of people thought the economy by now would really be in the toilet and the markets would be cut in half and all those other things. And what we're seeing is we've now seen 4 straight weeks of market growth for the Dow and the NASDAQ, or I'm sorry, for the S&P and the NASDAQ. And we're seeing unemployment still strong. And so to some degree, consumer sentiment is probably better now than it was a couple months ago, even though we're probably closer to the recession. And because single family data and MLS data, again, is reflective more of consumer sentiment and less of economic metrics and data, it's really hard to use it to predict where things are going.
Yeah, I think you're dead on there. Dead on. It's such a scared reacting point, right?
Yeah. What I will say is that the data that I've looked at in the markets that I'm in, and again, there's probably 4 or 5 markets that I've really looked at the data because I own single family in those markets. And so it's not just data for data's sake, it's data for my portfolio. What I'm seeing is that we're not seeing price drops. What we're seeing is lower transaction volume. And what I mean by that is that there are plenty of sellers out there, a lot more sellers than there were 6 months ago, not as many as we saw 6 years ago, but more than we saw 6 months ago. But we're seeing a lot fewer buyers, and we're seeing sellers who aren't desperate to sell. And I think this is part of why this recession is different than 2008 and why it's more like most recessions. Sellers aren't in necessarily a bad position. If you think about it, for the last 5 years at least, maybe going on 10 years, interest rates have been pretty low. So anybody that's bought a property in the last 3 or 4 or 5 or 6 years probably has locked in long-term fixed rate debt at 3%, 4%. And so you'd have to get into a pretty catastrophic financial situation like losing your job before you were struggling over a 4% mortgage, hopefully. And so I think a lot fewer people are going to be in a position like they were in 2008, where they had mortgages at 8, 9, 10% interest rates, that when the downturn came, they were forced to sell. And so when sellers aren't forced to sell, when they're not going through foreclosures, when they're not going through bankruptcy, when they're not losing their jobs, or they don't have high interest payments, when sellers don't have adjustable rate mortgages that are getting ready to reset and they can't refinance because credit's tight. When they don't have that, they might want to sell, but they're not going to be desperate to sell. And if they're not going to be desperate to sell, they're probably not going to take a super low offer. I'm not saying those sellers aren't out there. Obviously, people lose their jobs and people go through divorces and people get sick and people die. But again, it's not like 2008 where we saw all of these bad loans that kind of converged into millions of sellers having to desperately sell their houses all at one time. So we're going to see a lot of sellers out there. We're going to see a lot of buyers out there. But the sellers are kind of going to be sticking to their price here, and the buyers aren't going to be willing to come up. And so we're going to see this gap between supply and demand. And I think that's just going to result in stagnation in prices and lower transaction volume, and just a lot fewer deals being done. But that doesn't necessarily translate to prices dropping or prices going up.
Yeah, I think that's really strong. You know, from the distressed single family perspective, I think targeting homeowners who can't access their equity in their home because they can't buy another one, not because number one, the prices are still high, but number two, they can't qualify for a loan, you know, or they can't refinance, chiefly if they have an adjustable rate that's coming due. I think those homeowners are going to continue to be motivated to, you know, work with investors like us, you know.
Yeah. I mean, at some point, we are going to see more motivated sellers. We're going to see bankruptcies increase as people lose their jobs. We're going to see foreclosures increase as people lose their jobs. But we're not there yet. And so I think right now, basically, we're kind of at this game of chicken where sellers aren't coming down on price and buyers aren't coming up on price. And that's why we're seeing such long, I mean, everybody's talking about how we went from a month's worth of inventory to 10 months or 12 months worth of inventory. And that sounds like a crazy thing. The market must be collapsing. But in reality, it's basically not because prices are going down or people are desperation selling, they're just not selling. There just aren't many. And we see that. I mean, mortgage companies are laying off their agents and closing title companies. This is all qualitative because just stuff I've seen, but I've seen a number of title agencies that have started laying people off. I mean, there just aren't as many deals getting done, and I think that's going to be for the next at least several months.
Yeah.
So Dan asked, this may be a dumb question, but do you see Amazon or other large organizations getting into lending or other areas of real estate? I worked for Microsoft for a good portion of my career before real estate. And I remember having a discussion. This is before I did anything in real estate. But I remember having a discussion with a very senior person at Microsoft about whether Microsoft should get into the lending business, because at that point, Microsoft had like $100 billion in cash. This was back in 2000, 2001. They were sitting on about $100 billion in cash, and they were trying to figure out what to do with it. And they literally went out to employees and said, hey, what are your thoughts on companies we should be buying or getting into? And I remember at the time, I was having a discussion with somebody pretty senior in the company, and they said, there's been discussions about getting into lending. Would that make sense with all this cash that we have, whether it's lending just to employees for like buying homes or financing homes for employees or on a broader scale. But the reality is that if you think about a company like Amazon or Microsoft, shareholders are not going to be happy with the 4% return or a 5% return or a 6 or 7% return. And ultimately, when you're talking about being in the lending business, you're talking about 4, 6, 8% returns. Even if you're high risk mortgages, you're looking at 8 to 10% returns. So it's not a viable business model for a large company, especially a public company, because at the end of the day, it's going to make their quarterly reports look worse, because those just aren't returns that a company like that had to generate. A Microsoft or an Amazon or a Google, I mean, they need to be seeing 10, 15, 20% growth rates in order to support growing stock prices. And so lending just isn't, it's a low margin business that just isn't going to move the needle for them. And so I don't expect that we're going to see Amazon in that business or Google or Microsoft or any other companies. In terms of iBuyers, there's two types of iBuyers. There's the real iBuyers. They're the companies out there that basically set themselves up to try and take advantage of a soaring real estate market. Those are companies like Open Door. And I think that they're going to realize that long-term real estate values don't appreciate at a fast enough rate that it's a good industry to be in, unless you're really good at flipping houses. You're not going to get the natural appreciation. The reason the Open Door looks so attractive over the last couple of years is because they didn't have to be good at flipping houses. They just had to be good at waiting, because values always went up. But historically, real estate values go up at about the rate of inflation. And that's not going to be enough to appease shareholders. So that's for the real iBuyers. No, I don't think we're going to see too many iBuyers competing moving forward. We may see companies that are doing buy and hold, like the Blackstones that are buying and holding thousands of properties, but I don't think we're going to see the iBuyers who are doing the flipping. Then there's the fake iBuyers. So you look at Zillow. Zillow is a great example of this. Everybody was like, "Oh no, Zillow's getting into the flipping game. They're going to take over the world, or they're going to destroy their company," whatever it was. My take on that, again, coming from the tech industry, I was always a little skeptical of Zillow's plans there. In the tech world, typically you grow shareholder value by raising your top line revenue, not necessarily by raising your bottom line revenue. If you want to do well as Walmart or Target or Home Depot, you need to increase your bottom line revenue. You need to make more in profit. But if you're a tech company, you appease your shareholders and you get your share price up by increasing top line revenue, by increasing the amount of revenue that the company is generating, even if it's losing money in profit. And so my take is that Zillow at some point a couple of years ago said, what can we do to increase top line revenue as quickly as possible, regardless of the bottom line, regardless of profits? And somebody came up with the idea of, well, if we sell really expensive stuff, we do really big transactions, we can increase our top line revenue really quickly. You sell $1 million house, even if you lose money on it, you increase your top line by $1 million. And so my take was that Zillow got into that area of buying and selling simply to increase their top line revenue, which it worked. I mean, if you look at Zillow's stock price between when they announced back in, I think, 2019 and when they shut it down in last year, their stock price went up 8 times or something like that. And so I think from their perspective, this was just a way to boost stock price, and they were successful. And if you look at what happened just before they shut down their iBuyer program last year, a lot of industry insiders, a lot of execs in the company sold a lot of stock, and then they shut down the program, and the stock has tanked since then. So I feel like that was just a pump and dump on the part of Zillow, and so I know it's not a conventional thought there, but coming from the tech industry, that's how I see it.
That's awesome. Thank you so much for being here with us today, Jay. We're honored to have you and to chat about this. Maybe we can just end on how we can continue to follow you for people who aren't already following you. Where can we find you, and how can we stay in touch?
No, I appreciate that. So if anybody wants to either follow me or get in touch with me or invest with me or anything else, if you go to www.connectwithjayscott.com, just the letter J, connectwithjayscott.com, that'll link you out to everywhere. And I'll also say, for anybody that's interested in the math and the numbers and the finance part of investing, I have a new book coming out in a couple months. It's not yet open for pre-order, but will be in the next week or two. Go check out the BiggerPockets bookstore in a week or two and pre-order a copy. It's called Real Estate by the Numbers.
I love it. I'm definitely going to get it. This is right up my alley. Thank you guys. Thank you again so much. And thank you guys for joining us in the discussion. This is really valuable. I'm excited to take some action based on what I've learned today.
Awesome. Well, thanks everybody. I appreciate you being here.
Thanks. Bye.